Hello everyone. Well, the dollar is once again generally weaker after yet another in a long string of disappointing U.S. data. This time the Empire State Manufacturing Survey for February came out below market estimates and far below the January level. The release was enough for euro-dollar to break above the resistance at 137.35 and continue higher. Also, there was a surprisingly large net sale of U.S. assets in December, according to the Treasury International Capital data. Apparently, although the S&P 500 hit a fresh record high during the month, many investors sold bonds as 10-year Treasury yields moved up from 2.8% to break the 3% barrier. On the other hand, just looking at the price action, it doesn't seem that we've had the reverse of that trade. That is, people getting back into dollars as yields move back down to 2.7%. Maybe there's some skepticism in the market about whether rates will remain at current levels. So until investors feel comfortable buying U.S. bonds again, we're unlikely to see the kinds of large-scale capital flows into the U.S. that would push the dollar significantly higher. On the other hand, the Aussie dollar and the New Zealand dollar both lost against the U.S. dollar overnight. The weakness in Asian stocks and the fact that the PBOC drained funds from the money market hurt the two. The Aussie dollar wasn't helped either by news that Alcoa is shutting down an aluminum smelter and 2 mills in Australia. This is yet another sign of the gradual demise of Australian industry that we've been seeing recently. Now, we're looking in that context, the market's made much of the fact that the Reserve Bank of Australia dropped the line about the currency being overvalued from the minutes of its last meeting, but remember, it wasn't so long ago that officials were talking about 85 cents or lower for an appropriate value for Aussie dollar. I personally don't think, looking at what happened with Alcoa, I don't think things have changed that much, and I remain bearish on the currency. For today, the Bank of England publishes the minutes of its latest meeting, and the UK unemployment rate for January is expected to remain unchanged at 7.1%. I don't think the market's going to put the same weight on the employment data as it did previously after the Bank of England reformulated its forward guidance last week. In the U.S., the Fed releases the minutes of its January 28th, 29th meeting, the last meeting under Chairman Bernanke. The market will be interested in the discussion around the decision to continue with tapering down the monthly bond purchases. Also, what impact the emerging markets may have played in that decision, if any. Housing starts for January are forecast to slow to 950,000 from 999,000 in December, and building permits for the same month are also expected to fall. Such a sluggish housing market would normally be bad news for the dollar, just another one of this string of bad news. But I think given the bad weather conditions across the country, the market's probably likely to ignore the construction data, which is particularly vulnerable to snow. For more information, including technical analysis, please read the full comment on IronFX.com. You can also follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google Plus to get more trading ideas. This is Marshall Gidler, head of Global FX Strategy at IronFX, wishing you solid trading.